Sell-off intensifies as the benchmark breaks below the 25,400 mark, dragged by heavy selling in IT stocks amid continued AI disruption fears. The IT index is down for a fifth straight session, lower by almost 5%. Metals and PSU stocks lend some support. Bharti Airtel will invest 20,000 crore rupees in its NBFC arm over the next few years to scale digital lending. Morgan Stanley retains an overweight rating, citing long-term value from financial services diversification. Textile stocks are under pressure after the government halves the RODTEP rates, cutting export incentives by 50%. Brokerages warn of margin stress for yarn and fabric exporters like Vardhman Textiles and Arvind, with earnings risks if costs aren't passed on. MobiKwik on fire after its arm gets BSE nod to start its stockbroking business. The management says the business will start operations this year itself and be profit accretive in 2 to 3 years. Indoco is also buzzing on the back of a final ANDA nod for a seizure drug. Tata Sons board meet is underway to review group performance and consider a third term for Chairman N. Chandrasekharan. The proposal already has backing from Tata Trust, which holds a majority stake. Hello and welcome. We're joined by Rikin Shah, banking analyst at IIFL Capital this afternoon, to talk to us about what he's catching in terms of trends. Of course, he is at the IIFL Capital Summit, which is currently playing out, the conference which is playing out, and on the sidelines of that. Rikin, great having you. Let me first start off by understanding how trends are playing out and where exactly in the cycle are we? Because, of course, we aren't in a Goldilocks sort of period. There is some bit of a margin headwind that we are seeing. But at the same time, asset quality largely within the banking system remains resilient. There is some, possible upside going forward in the next few quarters with regard to especially MFI and SME. But talk to us, where within the cycle are we? Are we in a slow growth which could quicken? Could things get better going forward materially in the next 2 quarters?
So, good afternoon. So, in terms of where we are in the cycle, what we have been recommending and articulating is that after many years of deceleration in the earnings growth for banks, next 2 years, FY27 and 28, the sector is primed for inflection in earnings. From almost flattish earnings growth this year, we will be likely seeing high-teen earnings growth for next 2 years, which in itself is a rebound, but also higher than the broader market earnings growth. Now, what is going to drive this acceleration in earnings? Firstly, the pickup in the loan growth. What has been happening is that the banking system loan growth, which had bottomed at around 9%, is around 14.5% as we speak today. A part of this is also attributable to hardening of the bond yield. So a lot of the capital market demand, the corporate borrowing demand, which used to be catered to by the capital markets, has now come back to the banks because the rates that the banks are charging are suddenly looking a bit more attractive. So that has helped some acceleration in the loan growth. We expect the banking system loan growth to be around 13 to 14% next year as well. The second part of this piece is the margins. Since the RBI started cutting the rates, we are down by almost 125 basis points, but the aggregate net interest margin for banks is down only 10 basis points, far lower than what the consensus expectation was. Incrementally from current levels, we think that the margins will bottom out in 4Q for the sector after the December rate cut plays through in the 4Q results. But after that, with almost 40-50% of term deposit repricing still remaining, the margins will cyclically recover next year. And lastly, coming to the asset quality point, as you also pointed out, we are in a very pretty benign environment. And after seeing an uptick in the unsecured asset quality, whether it is MFI, personal loan, credit card, next year we see a broad-based improvement in this part of the unsecured portfolio. So net, all these three factors are starting to get aligned for the banks, and that should be driving the earnings acceleration.
So great setup, Rikin. So loan growth coming back is surely a tailwind. Margins coming back, albeit they might come back with a bit of a lag. So there's still some bit to go with regard to the margin recovery, and it may not be as steep as we've gotten used to seeing in the last cycle. And asset quality is looking good. But there's no positive tailwind with regard to recovery, right? That's the other piece. So there are a couple of pieces in the jigsaw where tailwind is in there, where a steady state would largely be a positive. But now talk to us, how should one place their bets? Is it the PSU banks which are looking solid in a cycle like this, maybe over the next 2 to 3 years? Or is it the private banks which have re-rated downward substantially? I mean, you used to see some of the large private banks trade at 3.5 times book. No longer the case. Is that where the pocket of opportunity is?
That's a fair question. I mean, if you look at the last few years, the PSU banks' earnings growth has been decisively ahead of the large cap private banks' earnings growth. And given that their starting point of valuations was also very low, they have outperformed the private banks meaningfully on any horizon, right? On a 1 year, 3 year, 5 year. But what we have recently flagged in our report is, if we look at the core PPOP growth, i.e. if you exclude the trading gains and the recoveries from the return of accounts, there is a now sharp divergence in that between the PSU versus private banks. So in the 9 months so far, what we have seen is that the private banks have delivered high single digit core PPOP growth, but the PSU banks have seen a degrowth of 2%. Now, sitting outside, it's not visible because the contribution from trading gains and recoveries is still very strong for PSUs. And that is what is aiding the reported PAT growth. But just to put things in context, for the private banks, this non-core gains contribute only 5 to 15% of their PBT. But for PSUs, it is as high as 25 to 35% of their PBT. Now we think that this has clearly peaked out and should start coming off. Because the return of pool of the assets from which these PSU banks are making recovery in itself has started to degrow, and hence the contribution of recovery from that will also naturally be lower than what we have been used to seeing in the last few years. And secondly, on the trading gains, a lot of the PSU banks have reduced their excess SLR holding from almost 25% of NDTL to 21-22%. So the recurrence of that trading gains may also not be similar in the coming years. So net, we think that the next 2 years, the large private banks can deliver high teen to 20% earnings CAGR. On the other hand, PSU banks will be delivering low double digit. And following the recent rally that we have seen in the PSU banking pack, we think that the risk reward is more attractive in the large cap private banks versus PSUs.
But why is that, Rikin? Do you believe that there is some risk with regard to PSUs this time around, which we are not currently seeing in the book? Because when you're looking at maybe, say, early double-digit growth where PSU banks is concerned, and late teen kind of growth where private banks is concerned, PSU banks are still placed way more favorably from a valuations perspective. They're still trading at 1.2 times book. And when I'm looking at it 1 year forward, that would largely be the valuation. I mean, excluding SBI, of course, which is the largest. And therefore, what kind of makes the case for you that private banks look attractive and PSU banks may not look as attractive? Is there some skepticism with regard to the book?
So clearly the point that we are trying to bring out here is that while the earnings is not faltering even for PSU banks, the risk reward is becoming less attractive, and that is on back of 2-3 things. Firstly, the ROAs have already plateaued for all of these PSU banks between 1 to 1.2%, and even within that, as I earlier pointed out, 25 to 35% is just coming from the non-core gains, which will decline in the coming years very clearly. So the ROAs have peaked and they will go down. And while we talk about valuations, while most PSU banks trade at around 1.2 times and SBI at around 1.5 times 1 year forward, the point that we also need to take into consideration is that the ROAs of the PSU banks are less than half of that for private banks, right? So this kind of valuation gap is not completely unjustified. While the ROEs are high due to the leverage that the PSU banks have, but the moment the ROAs start coming off, and given that their current ROAs are also almost half of private banks, I think the valuations have kind of played out in terms of the peak earnings that we have been seeing. So the juncture at where we are in the private versus PSU debate, I think that the PSU banks, we are ascribing peak earnings multiple to the the peak multiples to the peak earnings, and as the earnings growth start receding and private banks start doing better, some of the incremental money will start flowing towards the large private banks where they have underperformed meaningfully in the last couple of years.
You expect that this 25% component coming down will be replaced by maybe core earnings, Riken? The 25% component being non-core within the PSU banking pack? And follow on, with regard to therefore growth will largely be maybe single digit or early double digit in terms of PAT growth, or even that may be very unlikely to do where PSU banks are concerned.
So coming to the replacement of non-core with the core, the problem, Harsh, here is that if you look at the recent loan growth numbers that the PSU banks are delivering, that is coming mainly via underpricing on a lot of the segments. Whether it is home loan, auto loans, the personal loan segment, the pricing that they are offering is super competitive. And hence, despite the very strong loan growth, it is not translating completely into the net interest income growth because they are uber competitive on pricing. So while I do not have skepticism around the sustainability of loan growth for someone like SBI who has a low LDR of around 73%, many other PSU banks are also starting to hit the upper limit of their LDRs, which is around 83-85%, not very different from some of the private banks. So my limited point here would be that the loan growth momentum has been happening by underpricing on multiple segments, and hence that is not completely reflecting into the core PPOP growth, which, as I mentioned right now, is degrowing 2% in the 9 months so far. And what was your second question again, pertaining to the PSUs?
And therefore, what should PAT growth look like, Riken? Should it be maybe just about single digit, or would it be early double digit?
Early double digit is what we are expecting for the PSU banks. Within the PSU banks, while SBI has clearly done significantly better, I think that the liability franchise is the strongest for SBI, and hence it is a good fundamental business even from a medium to long term, but low double digit earnings growth for PSU banks and almost 18 to 20% earnings CAGR for large private banks.
Now, let me take it to the small and the mid-sized bank, because there's just so much happening there, right, Riken? It's a very interesting space. You've got certain pockets which are hit by asset quality issues where we're starting to see an unwind, right? A re-rating is already at play. Would you at this point venture and probably look at some of these names, maybe over and, would you look at them more favorably than you'd look at the large private banks either? Just give us a sense of that in terms of the pecking order.
Got it. So in the last 6 to 12 months, we were quite constructive on the mid-sized banks. From a RBL is something that we have been recommending in the last 6 months. And even some other mid-sized banks like Federal, Karur Vysya, AU Bank are reasonably good banking franchises. Now, incrementally from here, what we are recommending is that in the last 6 months, the significant outperformance that we have seen in some mid-sized banks has also to do with certain idiosyncratic catalysts that played out. Emirates fund infusion in RBL, Blackstone with Federal, Yes Bank getting from SMFG. So a lot of those triggers were there. While we focus back on the fundamentals now, the earnings have been cut across the mid-sized banks even for FY27, anywhere between 20 to 50%. And they have re-rated massively because the unsecured asset quality cycle started to get better. So from here onwards, I think the incremental returns for the mid-sized banks will be more led via the earnings growth rather than absolute re-rating. And there within that pack, we like someone like RBL, where we see there are a lot of catalysts going ahead once the RBI approval comes through for Emirates fund infusion. But from the risk reward perspective, given that the large cap private banks have not done much in the last 1-2 year barring Axis, we think that it is more attractive for large cap private banks. So in terms of my pecking order, it would be large cap private banks, then the mid-sized banks, and then the PSUs.
Rikin, last question with regard to everything that's playing out on the, I know you don't cover IDFC First in particular, but on the IDFC First stroke AU Small Finance Bank front, do you believe that this is a structural concern? That's point number one. And point number two, I'm sure that to some extent you're tracking it. Do you get enough comfort when a management comes out and says that this is only a single branch problem? This will likely not impact the bank as a whole. This is just a one-off problem. How should an investor think of it? Give us a sense, give us your take based on your experience.
So I would kind of refrain from getting into the individual banks, won't discuss them. But the way I would like to put it in perspective is that if you read the Haryana government bank order, it categorically says that for any government entity in Haryana going ahead, if they do not conduct their business with a PSU, they need to make a clear case of justification why that is not the case. So that is where it will hurt a lot of the mid-sized private banks and to some extent even large private banks. But if you think about why the government business usually was concentrated with the mid-sized banks, it was clearly for the rates. When you think about the capabilities of the large private banks, it was no longer on the rate, but the solutions that they used to provide. So from incremental perspective, what we need to watch out for is if there is a risk that something similar happens or some similar actions are taken by other state governments. At this point in time, nothing suggests that that is likely to happen. But I would think that PSU banks would be a natural beneficiary because some of this outflows from this mid-sized banks will go to them. And large private banks should largely be okay because their nature of relationship with the government is not rate-oriented, but more so from a solutions that they provide. But mid-sized banks will have to be a bit more watchful if some similar risk plays out in some other state governments.
It's been very good speaking with you. Thank you so much for coming in and speaking with us, giving us that perspective. I look forward to our next conversation. I hope we have it soon. But thanks so much for coming in today.
Thank you.
All right, viewers, what we'll do is slip into a very short break. We'll continue conversations on the other side. Stay with us. Welcome back, and we continue conversations at the sidelines of the IIFL conference, which is playing out. We have Balaji Subramanian, who is Senior Vice President and Telecom Analyst at IIFL Capital. Always great chatting with you, Balaji, right off the bat. But give us a sense, first off, this investment that Airtel is going to do, Bharti Airtel is likely going to do 60,000 crore of free cash flow, roughly. That's what the consensus says. With regard to FY26, FY27 numbers. When they allocate maybe 10% of that free cash flow, do you believe that that's a decent allocation? Is that what is largely also built into your estimates and other analyst estimates as well, you reckon?
Hi, good afternoon. Thanks for having me on your show. So the way I look at it is that, Bharti Airtel has seen a significant improvement in its free cash flows over the last 3-4 years. And as you were rightly mentioning, in the last 9 months of this year, they have generated close to 45,000 crores of free cash flow, and this is after making all the capex investments and spectrum related payments that they have to make. So that means, that is quite a lot of free cash flow generation that is happening, and with most of their network related investments on both 4G and 5G largely done, they are looking at expanding their presence in different adjacencies. So that is home broadband, where they have been investing quite a lot. That also includes enterprises, more specifically data centers, and they have been stepping up their footprint in the finance space, right from Airtel Payments Bank to Airtel Finance, which is something which they started about 2 years back. And what works to their advantage is that they have over 350 million plus subscribers whose data, at least in an aggregate form, they do have it, and that data bank is a treasure trove of information, and it also gives them certain insights on spending pattern, the cash flow patterns of those 350 million plus subscribers. So they have through Airtel Finance, they have been assisting personal finance companies to use that data in order to make credit underwriting decisions. And with having a certain experience in terms of getting their credit underwriting practices in place, I think this is probably the next step that they are looking, where they are looking to have their own NBFC, which will be 70% owned by Bharti Airtel. The remaining 30% will be with Bharti Enterprises, the parent company. And they have talked about capitalizing that NBFC to the tune of 20,000 crores over the next few years. So that is about 14,000 crores investment coming in from Bharti Airtel. And if you look at that from the overall scheme of things, it is still a small enough allocation, because as we just spoke, they are making close to 60,000 crores FCF on an annualized basis, and that should probably go up as their revenue goes up, EBITDA goes up, and the capex kind of flatlines or slightly comes down. So I think it is a step into an adjacency where they can monetize their data a lot more. But of course, the risk here, and one of the reasons I think why the stock has been weak today, is that it is a completely different cup of tea. Unlike earlier, where they were not having any direct balance sheet exposure, now if they are going to have a majority stake in an NBFC, that also means that they would end up taking credit risk, which is a completely new area for them. So I think that is one of the reasons why the stock has been weak today.
But Balaji, could it potentially become the size of a Chola or a Shriram or a Bajaj Finance?
I think this is probably, we have just seen the first step. So, one way to look at it is that 20,000 crores of capital, if one were to assume that they'll lever their balance sheet up by a factor of 5, we are looking at almost a loan book of rupees 1 lakh crores. So, that is a pretty sizable chunk, and even if they get their execution right, I think that is almost a 5-6 year story. So, at that point, I think we are probably, too early to make a comment, how successful they will be in the longer run. Because, this is an adjacency where clearly, they have some expertise, but running an NBFC is a completely different thing. And Airtel's track record in running something like a business which is completely different from telecom, at least at a large scale, is something which is unexplored and unknown to all of us. So, fingers crossed, but obviously, I think the first port of call will be something like 1 lakh crore of loan book size, maybe in the next 5 years or so.
Right. And Balaji, how should one therefore look at the significant cash flow it generates thereafter? So even net of this investment that they will make into their lending platform, it will still be significant, right, in terms of the free cash flow generation. I know that it's 11 lakh crore market cap and therefore in relative terms it's small. Do you believe that they dividend it out? How should that play be?
So as far as capital allocation is concerned, we have seen that they have significantly brought down their debt in the last 2 or 3 years. And with now the rights issue, 75% of the rights issue getting called, I think that will get them close to 16,000 crores. And that should be probably in their bank account by somewhere, either by late March or early April. So that means if you take out the lease liabilities there and the government debt, which is both Spectrum and AGR, their external net debt will probably be, less than rupees 10,000 crores. So that is barely anything. So I think the deleveraging part will be largely done with. And now, other than this Airtel money investment that they called out, in the most recent earnings call, they also talked about taking their data center capacity up to to close to something like 1 gigawatt, which will be almost a 25% market share in the data center market. Today, I think they are probably somewhere around 10 to 12% market share. And if they have to go to something like 1 gigawatt of capacity, that would probably entail close to a 50-60,000 crores of capex, maybe spread over the next 3-4 years. So I think that is one key area of capex going forward for them. Then, they have also been quite brisk in terms of their home broadband rollouts. And each home almost costs about $100 to connect. And if one is looking at maybe 10-15 million households that will be connected to home broadband, either through fiber or fixed wireless access, then one is looking at a meaningful investment over there as well, almost like a $1.5 billion. So I think this will continue, and of course there are also the ongoing investments that will keep happening, especially in terms of the backhaul, etc., fiber, where I think they still have some catch up to do as far as where Jio is today. So I think with that, maybe, if you take Africa as well, they will probably end up doing close to 35,000 crores of capex every year. But yeah, even with that, I think the FCF generation, as we discussed earlier, will be quite meaningful. And I would expect them to increase their dividend payouts, even after assuming, some stake increases in other subsidiaries like an Indus or an Airtel Africa. But I would clearly expect the dividend payouts to sharply go up. And that is what, telecom companies globally are all about, where the dividend payouts are high and the growth ratios are, what they are, which are probably towards the lower side. But of course, in India, we are still going through a tariff repair story. And as a result, the revenue growth, at least in the near term, should be fairly healthy.
Okay, Balaji, thank you so much. You've come in and you've given us that very, very good clarity, at least with regard to Airtel and everything that's played out over the last couple of days where Airtel is concerned. Thank you. We appreciate you coming and doing that. Viewers, there's the other one. IDFC First is perking up in trade after the Haryana ministry has said that the money has come back into the account of the government. And that's why you're seeing that kind of spurt on the stock price. Of course, that simply means that IDFC First has transferred the money back into the government account. Does in no way give us clarity as to whether IDFC First has repaired or has recovered that amount or not. So we'll wait and watch for that. But what we'll do is step into a very short break, continue coverage on the other side. Stay with us.
Back with closing trades right here on ET Now. Well, you can't take away from the weakness that IT names are consistently seeing, and there is no exception today either. In fact, the Nifty IT index alone is down about almost 5% as we speak. And of course, individual stocks are languishing or crashing way larger in quantum than that. But there's one company which has seen consistent order wins, and that's KEC International. So let's welcome on board Vimal Kejriwal, the MD and CEO at KEC International, and talk about these new 1,000+ crore rupee orders that they have won. Mr. Kejriwal, great to have you today on ET Now. Tell me, what percentage of this order win is inclined towards the transmission and distribution business, and what is the nature of these new orders that you've bagged?
Good afternoon, Aisha, and thank you for having me. Aisha, almost I'll say 90% or so would be on T&D, and the rest is on our cable business. Okay.
And what's the kind of execution on this? What's the kind of timeline with regard to execution? When's the revenue realization expected to happen?
I think revenue, at least on one of the orders, will start, has already started immediately, because we are aware of that is going to come in. Second one should start by next quarter onwards, Q1 of FY27.
Vimal, could you also highlight the margin profile of this composite order setup?
So these would be typically around, I'll say around 9 to 10%.
Okay. And T&D, give us a sense as to how competition is evolving in the space, because one is the components are the pricing on the raw material side is obviously inching upwards. How are you able to manage both competition as well as the kind of raw material pricing that's playing out?
So on competition side, Harsh, what is happening is that the market is exploding right now. So I think there is, in a way, more than enough work for everyone. And especially on the larger contracts, I'll say tenders, let's say 500 crores and plus there, the competition, I'll say, is relatively less intense and also more healthy, because most of the companies in this sector are large companies. So I think on the transmission side, we are quite okay with the intensity of competition. As far as the price, raw materials is concerned, I'll say many of our orders are on a pass-through basis. Wherever we have got fixed price orders, there we try to ensure the time of bidding that we can build in some buffer and all that, not too much. But I think if you ask me today, we are not bothered about or not worried or losing sleep over the price rises. Right now, we are in fairly good control of the price rise on the raw material. I don't think we have too much of open position.
Interesting. Okay, Vimal, great to have you on the show as always. Good chatting with you.
Thank you. Thank you.
Okay, let's just take stock of what the market is up to, and it's quite a bit of, bloodbath, so to speak, that you're seeing, and it's excruciating pain that you've seen in the last lap of today's trade. While of course the fall in the markets began pretty much from the word go, but we're now staring at a 300-point fall in the index, on the brink of breaching that 25,400 mark once again, which we in any case cracked on the futures earlier today. And IT single-handedly is the one which is making the market bleed. Look at a persistent, that's down 7%, Telecom is down 7%, Coforge is down nearly 7%, LTIM down 6.5%, HCL Technology is down 6%, and that's pretty much the state of affairs for both Infosys as well as TCS as well. But the one case that we've been tracking closely has been IDFC First Bank, and the Haryana Chief Minister Nayab Singh Saini today informed the State Assembly that the government has actually recovered over 550 crore rupees from IDFC First Bank within 24 hours, and that the government will conduct a thorough probe into this particular matter. Listen in.
यह स्पष्ट करना चाहता हूं कि कल का जो प्रकरण हरियाणा सरकार के विभागों का पैसा था और बोर्ड कॉर्पोरेशनों सहित संपूर्ण राशि मात्र 24 घंटे के अंदर अंदर हमारी सारी राशि वो वापस हमारे खातों में जमा हो गई है, जो वो राशि गई है। माननीय अध्यक्ष जी, लगभग बैंक द्वारा 556 करोड़ रुपए जमा कराए गए थे, जिसमें लगभग 22 करोड़ रुपए ब्याज का भी हमने लिया। जो ब्याज था वो भी वापस आ गया, उसको भी हमने जमा, ये हो गया है, और उस पूरे पैसे की रिकवरी भी हमने मात्र 24 घंटे के अंदर कर ली है। बैंक ने यह भी माननीय अध्यक्ष जी अवगत कराया है कि यह प्रकरण मुख्य रूप से बैंक की एक ही शाखा चंडीगढ़, क्योंकि बैंक से भी पूछा गया है, बैंक की एक शाखा चंडीगढ़ के 4-5 कर्मचारी थे जिन्होंने मिली भगत करके इस बात को अंजाम दिया। सरकार बैंक के साथ मिलकर के माननीय अध्यक्ष जी यह सुनिश्चित करेगी कि इस प्रकरण में शामिल रहने वाले बैंक कर्मी या कोई निजी व्यक्ति या कोई सरकारी कर्मचारी भी है, मैंने कल भी कहा था माननीय अध्यक्ष जी, इसी सदन के अंदर मैंने कहा था कि अगर कोई सरकारी अधिकारी भी होगा या कर्मचारी होगा उसके खिलाफ सख्त कार्रवाई करेंगे।
Back with closing trades right here on 89. What a mammoth fall. You can't take your eyes off from what's happening within the IT pack right now. I mean, just look at the kind of the magnitude of fall actually within the IT names. Sure enough, there is a Unilever, a JSW, Coal India, ONGC, Cipla, etc. But they can't really outweigh the weakness that you're seeing in IT specifically. Let me welcome on board Shivangi Sarda then and find out what she's recommending doing in this market. Shivangi, how do you trade this 300-point fall on the index?
Very good afternoon, Aisha. Thank you for having me. So it's just a matter of survival in this market. We've seen that the market has breached its low of the last 7 trading day band of the 16th February, and we have sunk below 25,350 marks. But then again, we've seen that the sentiment is quite shaken right now because of the entire IT story and the AI fears that has crept in. And which is why Bank Nifty is holding up, but the Nifty index is losing momentum. So now we're looking at a ranged or a capped upside index as of now. And of course, today was monthly expiry, so a lot of volatility was expected. But 25,800 is the next zone where call writers can be seen making their position. Now, this needs unwinding for fresh buying to begin with, but this market fall could make an attempt to stop near 25,200 marks. So these are the levels on the both the sides that one could look out for and track. Now, of course, talking about Bank Nifty, this one has been more resilient, and we have seen some of the heavyweights holding up. It is comfortably trading above 61,000 levels, which is quite positive. So 61,000 closing would be important. If it manages to close above the same, then we could see momentum towards 61,500 zone.
Right. Okay, Shivangi, hold on to that thought. Lots of individual stocks as well to discuss, but we will take a very quick break. Come right back, continue our chat with Kunal Bothra as well as Shivangi Sarda.
Welcome back, and we're joined in this afternoon, of course, we're with Kunal Bothra, but let's also bring on board Jonathan Shizell, Deputy CIO, Westminster Asset Management. Shivangi Sarda obviously continues to be with us as well. Jonathan, good afternoon. Great having you. Let me first start out with a global context. There's obviously plenty happening in the global marketplace. Talk to us about what the pessimism is globally, because while we are seeing that pessimism, we're not feeling it. There isn't any material correction, at least in the US indices. We're just about 5% away from all-time highs. So pessimism, if at all warranted, could we see a deeper correction? Where do you sit at in terms of the uncertainty that's playing out?
Yeah, good morning. I think clearly there's been a massive rotation that's just started, and I think probably has a lot further to run, where you've seen many global investors overweight the US, overweight the Magnificent Seven type of mega cap technology stocks. And clearly there's some jitters going on, and we've seen them shifting out into more real asset stocks, cyclical stocks, industrials. So whilst the headline index hasn't really come off a great deal, you're seeing a lot of rotation underneath the surface. Obviously, on top of all that, we've got the ongoing macro issues with the whole tariff confusion, which is causing further angst in various parts of the world. And then, I guess the final point would be, the massive disruption we're seeing in parts of the market which are deemed to be at risk from AI. So yeah, it's the sentiment's pretty shot in certain areas, but if you were to be invested in, for example, some of the Asian hardware tech stocks, you wouldn't quite know what the problem is at all, because they're making new all-time highs. So yeah, a lot of rotation and a lot of divergence.
That rotation, Jonathan, what do you recommend going overweight on, and what would you say is a complete avoid in the Indian markets right now?
Yeah, so I guess the problem in the short term with the focus at the moment on the disruption that's going to potentially be coming from AI, we've seen the Indian IT sector getting absolutely hammered, and whilst some of the valuations look quite attractive, we certainly a little while back did reduce our weightings and have exited a lot of these positions, just until we get more certainty about how this whole thing plays out, if we're going to get it anytime soon. So for the time being, I think underweight IT makes sense. The banking sector, the Nifty bank index continues to sort of trade up near the highs. That looks fine. And the underlying macro for the Indian economy looks fine. So the more cyclical sectors remain still quite attractive to us. And obviously, with the nerves around the whole tech space everywhere, I think people are beginning to look back in some of the more defensive sectors as well in the short term. But, I think all in all, we're certainly not too bearish as we sit at the moment, because, usually, historically, a strong January portends for a pretty good year, but there will be some volatility in that period. So yes, at the moment, there is a rotation going on to more defensive and even some cyclical sectors out of IT, and that probably will last a little longer.
Individual names like Eternal, it's just about around that 250 odd level in trade. And I mean, the weakness today is beyond IT, while IT is a major chunk of the contributor to today's fall in the markets. Look at L&T, that's down 3.5%. HDFC Bank is down over 1% right now. M&M as well is lower by 1%. BEL is down 1.5%. Trent is down almost 3%. Shivangi, coming on the charts of L&T, I mean, that's quite a sharp fall that one is seeing. What's your reading next?
Stock has given up, the gains of the last two trading sessions. And, talking about this stock, this has been, relatively strong. And on a year-on-year basis, it has moved up, forming high top, high bottom from the last 6 years. So consistent strength can be seen here. And of course, today's fall could be, taken as a short-term short-term weakness over here, but then again, the overall strength remains intact in this one, and this one is definitely a portfolio stock. So one could actually utilize this dip to accumulate in their portfolio.
Interesting. Kunal, I wonder what you make of the moves with regard to IT.
For the first time in the last 20 days, Harsh, the indicators for IT index have come back into an oversold territory. And it's not a minor oversold territory. We compare this over the last 15 to 17 years of data. And for the first time, I think in the last, rather 3 times in the last 17 odd years, 2011 onwards, the Nifty IT index, the indicators, for example, the daily RSI has come back sub the 15 mark for the IT index. The last time it was seen was in 2020. I think it was almost at 17th March 2020. and a very similar kind of a time frame in 2011-12, where the IT index came back into a deep oversold territory. What happened post that in both the earlier scenarios was that for the period of the next 1 week or 1 to 2 weeks max, there was a further correction for the IT index. But then the bottom which was made for the indices thereafter, I think was a very formidable bottom which the index did not test for subsequently over the next many years. So maybe I think we could be at a point where potentially over the next 1 or 2 weeks, if there is any kind of a further correction for the IT index, that could probably throw up opportunity to try and go contra into the IT index.
So you still wait and watch?
Still wait and watch, but then from being completely out of radar, now I think it should start to be on the radar for investors, specifically for someone who's looking at a value buy, and that too at such a kind of a contrarian, mouth-watering opportunities in terms of indicators.
But again, I guess, Jonathan, the question is, how much longer will the market wait for the numbers to actually trickle in and justify whether IT is a good buy, even after the valuation correction that one has seen? And then again, do you bet on IT services plays or perhaps a niche like a Persistent or a KPIT?
Yeah, no, you're totally right. And as we know, markets can unfortunately extend both ways, both on over and under valuation for some time. And the fact is, we still do just not know fully the impact that some of these new models are going to have on the IT business model. So, there is uncertainty, and uncertainty breeds caution. And therefore, whilst valuations are attractive, and there's no doubt about that, and by historical standards, these stocks are beginning to look very interesting. But the simple fact is there is a change going on, and we don't quite yet understand how it's going to play out. I have no doubt that a lot of the IT stocks will benefit overall from what's going on in AI. But in the short term, the market's not prepared to offer any credit for that. So I think we've got a bit of a while to play out before we get some cold analysis on how it's going to play. So yeah, the bigger guys are probably more at risk, and some of the more specialist, smaller players and mid-tier players probably in certain segments should be slightly better place to hide if you've got to be there. But I think in the short to medium term, we just don't quite know yet.
Well, interesting. All right, Jonathan. So therefore, how should one, or what triggers should one look for if one were to place bets on IT? What kind of clarity would one require, especially where traditional Indian IT is concerned? Give us a sense as to what will you be looking for with regard to comfort on these businesses before you start either putting in fresh money or taking a position against.
So I think firstly we need to see some fairly robust comments from management, senior management in these businesses to actually clarify the impact of AI on their businesses. Yes, there has been some quite a bit of talk so far, but we just need more at the moment because clearly these models are coming out at a huge speed now. So I think this is not going to be something that's going to go away anytime soon. So we need a very robust business model for how these managements are going to deal with the change. I think that's probably the most important thing that we need to see. And then secondly, order wins, these sort of, if we can see order wins going on at the moment and carrying on and giving us, again, management giving a indication about the pipeline of potential new wins as well, that will be very helpful. Because certainly at the moment, I think a lot of businesses are holding off from awarding contracts while they just work out what's going on. So there is a lot of uncertainty, as I mentioned, and really, if management teams can at least begin to address that, that would be helpful.
Shivangi, okay, let me come to you with regard to and shift focus from IT to maybe banks. What's the positioning like over there? Because that's probably one pocket which has done okay in all of the tough market situation we've played over the last few days, especially on the PSU banking side. You still look positively at that particular cohort of stocks?
after the dent that IT has made, banking has been one pillar which has held on to the strength of the market. And looking at the PSU space, of course, we've seen that this index has been supported by the PSU banking names itself, and somewhere there is still resilience lying here. And I'm looking at stocks like Federal Bank or Canara Bank. But of course, if one has to go for a little stable name, then one can also look for SBI. But definitely, these stocks are a must hold as of now at these times, because these are the only space which are showing strength even in such a volatile and crazy market.
There are hardly a few odd winners out there. Bandhan Bank, for instance, which is higher by 3%. Power India has been seeing some very good moves off late. Another almost 3% of a gain today as well. Vari Energy is up 2.6%. It's in fact sitting at the high point of the day. If we can bring up some of these intraday graphs, a Bandhan Bank, a Power India, as well as Vari, which is now up 3.6%. Chola Finance has been very strong. A good 2% of an uptick over there. And then there is Torrent Pharma as well, which is higher by about 2%. Jonathan, how big could the GLP-1 generic opportunity turn out to be for some of the Indian pharmaceutical majors?
Oh, I think massive, in a word, massive opportunity. It's we're going to see how it plays out. I mean, clearly the two market leaders, Eli Lilly and Novo, there is a lot of market share available. So I would agree with you. I think the opportunity is huge, and there's just seemingly more and more uses they're finding for this particular compound, and the benefits from taking it. So yeah, absolutely massive opportunity.
Right, interesting. That's the take coming in on pharma right now. Shivangi, to your mind, is there any sector which is showcasing its defensive nature right now? And could pharma be that one hiding space?
Yes, absolutely, Aisha. I think pharma is that one space where people are finding a little bit of comfort in such kind of a market. In this space, particularly, I'm looking at Torrent Pharma, which has caught my eye, and this has given a breakout of the triangle formation on the daily basis. And the breakout today, the price surge is being accompanied by volumes, which is a kind of positive here. It's given a range breakout on the monthly basis as well, which is giving a room for a more upside potential over here. And of course, we are closing the February series on a very positive note with good rollovers here in this one. So this one could be definitely kept on radar. And the next targets that I'm looking out for Torrent Pharma is around about 4,600 levels with a support of 4,300 levels.
Okay, let's switch focus though. Let's go across. We had an exclusive interaction with Voltis Managing Director, Mr. Menon, and he says that the company is working with the government to enhance exports. He's also expecting better demand from Tier 2 and Tier 3 cities. Sumita here with that conversation.
The Tier 2, Tier 3 and Tier 4 cities, they are becoming a large markets for all the air conditioning products. The large cities, of course, the metros are always a big part of the market, but the new upcoming towns, we are seeing this entire urbanization thing happening. So there are a lot of Tier 2 towns, Tier 3 towns, Tier 4 towns where we're seeing a huge demand in air conditioning. Air conditioning is no more sort of a luxury, it is becoming a necessity of sorts.
So when you talk about demand, I mean, this year, as it is, we are still in February. It seems like, we're in the midst of full-blown summer. Do you expect more demand than last year, given the fact that unseasonal rains roiled demand last year for the industry?
You're absolutely right. So, for example, if you wind back 2 years, 2024 was a summer which was like a very hot summer. It was an extended summer. It began quite early in February and went right up to June, July. The previous year, 2025, was a summer which was the temperatures never picked up. There were a lot of intermittent rains, as you rightly said, which completely kept the temperatures under check. And it was a very short window of less than 15 to 20 days of some moderate heat which was there. So compared to the 2024, the industry saw a degrowth of roughly 25% during the summer months of last year. This year, we are assuming that we are getting a prediction that it is going to be a normal or or a little above par summer. And from whatever you were mentioning about what you feel outside, temperatures above 30 degrees at this time of the year, we are looking at probably a long, extended, and a little above par summer.
That sounds terrible news for consumers, but good news for businesses like yourselves. So I also want to ask you about your international diversification, given the fact that you do have markets in Africa and West Asia as well. And when we speak about your international foray, your international focus, what exactly are you looking at, given the fact that India is negotiating trade agreements with several countries to sort of diversify our focus from remaining concentrated to one geography? How is that really panning out for you?
So currently our presence is not very much in the products business. Our international footprint is essentially on the contracting business. We do these large mechanical, electrical and plumbing projects, especially in the Middle East, and that is our large projects play. We are not a major exporter of the air conditioners or any of the other products in the product space. Now, India as a country has never been a big exporter of the air conditioners. For example, the entire world market, export market, is dominated with one big player, which is China, which does a bulk. There's a heavy lifting in terms of the exports that they do. The second country which comes close to them is Thailand, which roughly does a 14 to 15% of the exports. India as a country has a play of less than 1%. You can imagine, so it's a tiny play. The government and we are working together, and we are seeing whether there can be some sort of via media where we are able to at least play a game almost like the Thailand thing, where at least a 14 to 15% global market can be done.
Right, okay, that's the take coming in right now from the Voltas management and the kind of demand fillip that they anticipate because of the early onset of summers, especially in the northern parts of the country. But the Tata Sons board met today to review the group performance and consider a third term for Chairman N. Chandrasekaran. In fact, the proposal already has backing from Tata Trust, which holds a majority stake. Anurag Joshi, my colleague, is here with all the latest developments from that board meet.
The Tata Sons board meeting is currently underway, but indications are that it should be concluding soon. There are 6 board members, and they are deliberating on resolutions. And one of the key proposals before the board is to consider approving a third straight term for Chairman N. Chandrasekaran. Chandrasekaran had secured his second term in February 2022. That was for a 5-year period. So his current term is until February 2027. And this board meeting is very crucial because it is also happening at a time when the Tatas are seeking to boost investments. They're making massive investments in new areas like AI, EV batteries, semiconductors, and also are seeking a transformation for the country's second biggest airline, Air India.
Okay, thank you so much for that, Anurag, for giving us those details. Now, in terms of certain stocks or sectors which are buzzing, Jonathan, I'm curious to know what's your take with regard to the metals pack, because that's the one pack which has done very well for itself over the last 6 to 12 months. It's been one of those outperformers. At this juncture, how should one look at it if one were invested?
I think you've got to stay there. I think the whole metal space continues to look very interesting, be it, obviously the steel space and all the way through up to the actual miners. I think there's definitely a move afoot towards these sort of sectors away from some of the software and IT sectors. People have been under-owned a lot of these sectors for a very long time. And I think the backdrop looks quite healthy from an earnings perspective. And valuations generally, not for every company, but generally as the pack, still look quite attractive. So I think if you're in the sector, I think we certainly are overweight ourselves. And we think globally commodities and the whole sort of commodity space does continue to look very interesting to us.
Bunch of approvals coming in from the cabinet now, some of the infrastructure projects, but I think the bigger one is the renaming of the state of Kerala to Keralam. Any thoughts?
Well, they have renamed the state, so yes, that's just how it is.
Just a little, I guess, difficult to now memorize that Kerala is going to be called Keralam. That is really the bigger takeaway for all of us. But yeah, they've approved some power sector reforms as well. So we'll try and get our reporter to get in more details in terms of what this actually entails, and of course a bunch of infrastructure projects as well, which have been given the go-ahead. Sorry, Harsh, you were saying?
Yeah, I mean, that of course is something that will be critical to see as to who the beneficiaries of all of that Capex that's coming through will likely be. And of course, we'll have to try and distill that. Yeah, cabinet approval for that is what is coming through in terms of the outcome of that meeting. But let's go across. We had Jim Walker of Alethea Capital, who warned that trade barriers will persist, keeping global uncertainty high, supporting gold, and pressuring US equities. And it's time for investors to start questioning the high investments that have been made in AI. Listen into a slice of that conversation.
Well, it's reflected in the gold price, in my view.
Yes.
That's certainly one of the areas of US exceptionalism that's on the downtrend, which is the dollar and the dollar's role in the world. But yes, of course, the equity markets have been very resilient. There's a lot going on in the equity markets in the US. There's big companies there that are spending lots and lots of money. And one of the themes that we were trying to get across to the audience this morning in the presentation was that this is the economics of impossibility, that they can't absorb the amount of capital that the big tech companies are talking about, given the shortages of electricity and skilled labour in the United States. So eventually markets are going to realise that this is not going to happen, and that at that point there's going to be a reassessment of equity prices in the United States. Our year-end strategy report was called the mother of all busts. And I think we're still heading into that. Not in the sense of the stock market, but just bust egos, bust capital expenditure plans, and I'm afraid bust economic growth.
But how long before the market will question profitability of all the Capex that's going in?
Well, they should be questioning it now, because the returns on these investments are not instantaneous by any means. And the investments have got to be put in place. They've got to be able to then sell, and of course it's AI that it's all about, they've got to be able to sell the products.
Okay, not too far away when the market is going to begin questioning all the investments which the Mag 7 are making into AI. But just want to quickly map where the market is settling in for the day. More than the market breadth, or the broader universe rather, it's today more about the Nifty pain, and that's all because of the IT names. Telecom is closing in with a 6.5% loss, almost a 6% cut for HCL Technologies. TCS down nearly 4%, Infosys down 3.6%, L&T down about 3.25%, and Eternal as well, which has shaved off about almost 5.5% in trade. Could I identify the charts for Eternal? Because, one thought that it's going to stabilize around those 270 odd levels, and upper end of the range would be around 320 thereabouts. But I guess, still a lot of correction in store one has seen.
Yeah, this is a in fact, the third round of correction for Eternal in the last, I think, a couple of months. The earlier correction, a very recent correction for the stock, was from the 300 to 250 or 45 kind of a mark. The stock bounced back towards 300, 310 levels. And now I think in this month itself, the stock has ebbed off almost 45, 50 plus points from this recent highs around the 300, 310 mark. But, on the charts, of course, it's come back towards that strong support territory from where the stock has seen a bounce back couple of times around this 250 levels. And the good part is that the indicators are all also coming back into an oversold territory for Eternal, even this time around, just like very similar to the last time. So unless there is any kind of a major shift in the structural scenario for the stock price in terms of events or news flow, I would believe that maybe at this 250 levels, the stock could probably find some bit of support. So we'll wait for maybe another couple of days, but if the stock holds on to this 250 levels broadly, then I think there could be a very strong case of a decent bounce back at play.
Right. Shivangi, any favorites within the defense pack?
Of attention of lately, with the global cues and the kind of market volatility. But we've seen that follow-up buying is missing in most of the counters, and which is why I would recommend a little wait and watch over here on this space.
Okay, wait and watch on defense. Is there a view, Kunal, that you have with regard to the metal index?
So I think the metal index is still into a very strong uptrend over here, even after the last, I think, 1 week of sideways price action. So, relatively, metal index is the third best performing index when we look at this from, say, the last, I think, 2 months back or 1.5 months back. I think the first one was PSU banking names, the second was CPSE index, and the third ranked up to the metal index. But the second part is very interesting. In a scenario where metal indices and metal stocks are considered to be very high beta, very volatile, they've gone through a rally of 20%, 30% in many cases, more than that. You would probably expect that when the market goes into a sudden phase of a correction, maybe a case like today or over the last couple of days, you'd probably have expected that maybe the metal stocks would probably have fallen down by at least 10% to 15%, given the context of the market. But they are less volatile. So when sectors detach themselves from the benchmark indices in terms of the beta nature, that itself indicates that these stocks and these sectors are into a very sweet or a steady uptrend which could last for a prolonged period of time, devoid of the market volatility. So I would probably believe that in that context, metal stocks, they look fairly attractive, and I think at current zone, I would still be bullish on few of the counters. Tata Steel, JSW Steel, SAIL, Hindalco, these could be prominent bets at current levels also.
Very interesting. Okay, so that's with regard to metals. Within consumption, Shivangi, is there a pocket that you favor? And if you can give us some flavor around that, maybe a couple of names.
Consumption, if you look at, on a year-on-year basis, this index has fairly moved, but then we've seen that pockets and sectors which have performed better than this consumption pack. Of course, my focus would be on the consumption pack only for a diversification bet in the portfolio. But one stock which is really catching my attention, I'm just shifting focus, is NTPC, which has given a consolidation breakout of the last 14 trading sessions. So this one could be kept on radar for a good BTSC trade.
Okay, that's a call coming in on NTPC. Shivangi, we'll let you go on that note. Thanks as always for your time. Kunal, good to have you on the show as always. Well, counting down to the market close then, and it definitely has been quite the painful session today. The Nifty itself is closing in with a 300-point fall, and that was really the bottom for the day, led, of course, by IT and other heavyweights like an L&T, Eternal. You also had the likes of a Trent, SBI Life, BEL, iShares, Bharti took quite a bit of slide today. HDFC Bank as well was a laggard, as was ICICI Bank and Maruti and ITC as well. On the flip side, though, NTPC, like Shivangi was just highlighting, that was a winner. JSW Steel, Coal India, Hindalco, Unilever were some of the other names which actually managed to hold out in trade. In fact, if nothing, FMCG was one of the key standout performers along with some of the metal names. So you had a Nestle as well, which held out by about 0.7%. But the broader market is where you can see the acute pain within the IT pack, because all the 5 losers are from within the IT pack. LTIM down 6.7%, KPIT down 6.5%, TechM down 6.5%, Persistent down 6.5%, and Coforge down 5.9%. And these are the futures figures that I'm talking about. On the flip side, Bandhan Bank, Vari Energies, you had Power India, Chola Finance for some of the green ticks today, as was the case maybe with the Samman Capital as well, although it actually closed in lower. I stand corrected there, but did see a significant OI build-up. Motherson Sumi, SAIL, Sun Pharma, these were some of the other active participants in trade. And then IDFC finally managed to recoup some lost ground and closing in the green.
Yeah, I mean, IDFC, I'm talking about lenders. There's also Northern Arc Capital, which is up 3.5%. Motilal Oswal initiating coverage, 44% upside. There's also the likes of AU Small. I wonder where that one has closed in at, because there was visible pressure on that stock price as well. And we've seen that stock also is perked up 3% at close in trade. So a decent outing for some of those names which got beaten down on the back of everything that's played out over the weekend. But we saw a bit of a bounce back there. In terms of the advanced decline itself, it was extremely weak on the overall market itself. The advanced decline was nearly 3:1, maybe more tilted and got slightly better towards the fag end of the day. If you look at the graph, that's what you'll notice. But around 1,650 declines to 730 advances, it didn't look like a pretty sight at all. IT was, of course, the dominant force. The mid-cap index held up surprisingly okay. It's down around 0.25% thereabouts. The small-cap index was down 0.6%. It was actually the Nifty 50 where a bulk of the pain was. In terms of sectors, of course, we spoke about it, but let me quickly reiterate. The Nifty Realty Index was down 2.5%. That was the other one, which was in some bit of pain. 0.6% lower on the Nifty India Defense Index. Metals saw a last-ditch surge. I mean, if you look at the intraday chart on the Nifty Metal Index, and let's pull that one up, you'll get a sense of what I'm saying. Right towards the end, we saw a bit of a surge on the Metal Index, which kind of carried it up nearly 1% in trade. And there you go. That's what I'm talking about. From the day's low, it was a quick surge over the last maybe hour and a half or 2 hours of trade, which was what led to the kind of close that we saw. Very, very close to the top of the day. 1% higher on the Nifty Metal Index. Those are your constituents. Lloyds Metals, SAIL, NMDC, some of the smaller names. Vedanta was also up 2%. JSPL, Nalco. But when you're looking at some of the larger names, the Hindustan Zinc, the JSW Steels, they also did fairly well for themselves. 1% up on both of those. I wonder what Tata Steel has closed in at as well today. But the Nifty Metal Index, of course, continuing to be very, very close to those record high levels, 12,000 plus. 0.5% higher even on a Tata Steel. So that's how the metal pack has behaved in trade. And one of the top outperformers, frankly, of the day was the Nifty Metal Index. Outside of that, the Nifty Energy Index did fairly well for itself. Those cabinet approvals coming through saw an impact, at least on stocks like an NTPC, on a Coal India. There you go. The Nifty Energy Index, that was the other one which saw a bit of a surge. And some of the larger cap names, especially in the Nifty basket, benefited from that kind of surge that we saw post the cabinet meet. But with that, completely out of time on this edition of Closing Trades. From Aisha, myself, everyone who puts this show together, thanks so much for watching. Stay with us. More action to follow on the other side.